Most Indian investors believe that the Indian stock market is controlled only by local news, Indian companies, or Indian government policies. But the truth is, a decision taken in the United States can move Indian markets within hours. Today, I'll explain why U.S. interest rates control the Indian stock market in a simple and calm way, without hype, without stock tips. To understand this, we need to zoom out. The global stock market is not made of separate countries. It is one connected financial system, and at the center of that system sits the United States. Why? Because the U.S. dollar is the world's reserve currency. Most global trade happens in dollars. Big institutions invest money across countries. And the most powerful financial institution in this system is the Federal Reserve, also called the Fed. What the Fed actually does. The Federal Reserve controls interest rates in the U.S. When the Fed raises interest rates, borrowing becomes expensive. When the Fed cuts interest rates, borrowing becomes cheaper. But here's the important part. When U.S. rates rise, money prefers safety. And the safest financial assets in the world are U.S. government bonds. So global investors ask one simple question. Why take risk in India when I can earn safe returns in the U.S.? That's when money starts moving out of emerging markets, including India. How money flows from U.S. to India. Let's simplify this with an example. A large global fund has $10 billion to invest. When U.S. rates are low, U.S. bonds give low returns. Investors search for higher growth. Money flows into countries like India. Indian stocks rise. When U.S. rates go up, U.S. bonds become attractive. Risk appetite reduces. Money flows back to the U.S. Indian stocks face pressure. This is why you often see headlines like, "Markets fall as FIIs turn sellers." FIIs, foreign institutional investors, don't hate India. They simply follow global money cycles. Why Indian markets fall even without bad news? Many investors get confused. They ask, Indian companies are doing well. GDP is strong. Then why did markets fall? The answer is simple. Markets don't move only on fundamentals. They move on money flow. If global money exits, Nifty can fall. Mid-caps suffer more. Small caps get hit hardest. This is not manipulation. It is global capital behavior. What should a normal investor do? This is the most important part. You cannot control U.S. interest rates, global inflation, or the Federal Reserve's decisions, but you can control your emotions, your risk, your time horizon. Long-term investors understand one rule. Global events create volatility, not permanent damage. Markets fall, markets rise, but discipline compounds. So remember this. U.S. interest rates affect global money. Global money affects Indian markets. Short-term movements are noise. Long-term thinking is power. If you understand why markets move, you stop reacting emotionally and start investing rationally. If you want calm, honest explanations of the U.S. and Indian stock markets without tips, without noise, subscribe to this channel. This channel is about understanding money, not chasing it.